Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead.
LME 3-month copper. Here we are, and once again I feel obliged to state, as I have now for many months before, that there are three important zones which in turn have become either important support zones or resistance areas and continue to impact on this market. Above the current market is the highest and possibly the toughest of these congestion zones between 97.50 to 99.95 area, though recently prices managed to stray above it only to each time get slapped down. Today we're edging up and out of the next one, the middle zone in the 93.95 to 96.06 area, which at the moment contains a slowly declining mauve medium moving average, currently at 94.52, and a supportive green rising short medium moving average, currently 95.03. Finally below is a small one between 91.83 to 92.56. This last one saw the market push up through it 11 weeks ago, then get capped by the next congestion, which is that 93.95 to 96.06 zone, plus at the time the declining short medium moving average, and we ended up back down below it again before 7 weeks ago tackling it once more and 6 weeks ago pushing up through it. Prices then traversed the free area up to the 97.50 to 99.95 area, where we tried pushing even higher for nearly 2 weeks. However, 4 weeks ago prices started their journey back down, pushing below and out of the 97.50 to 99.95 congestion area and into the current 93.95 to 96.06 congestion zone. For the last 3 and a bit weeks, prices have been pushing down into the mauve, slowly declining medium moving average. And if it wasn't for this moving average, then prices may have been a lot lower. The mauve medium moving average is now being reinforced by the green rising short medium moving average. Now, I don't know how good a reinforcement this green short medium moving average may be, but for now it looks quite good, especially being so close to the mauve medium moving average and within that 93.95 to 96.06 congestion area. So for now it seems we will continue to rely on those three congestion bands for the activity and direction of this market. LME 3-month aluminium. There continues to be a lot going on here on this daily chart. The move high over March, April, May, and I suppose even the most recent one from early August originates back to late February with the break higher from a diamond pattern type formed back then between late October 2023 to late February 2024. Now please remember this, as it is the congestion generated by this diamond pattern on the wide between 2100 to 2400, but really between 2156 to 2297, that caused the very recent rise since late July, though obviously not the original pattern itself. Okay, so the decline from late May to late July was stopped by the extension of the neckline, currently at 2215, of the June to July 2023 reverse head and shoulders pattern. From this base part, prices started building and experimenting upwards, and this was from the same price zone as the earlier diamond bottom pattern, roughly between 2400 down to 2100. In the process, prices pushed up through some significant resistances, which are now turned supports. The nearby notable ones were and are the congestion zone from mid-June to mid-July between roughly 2485 to 2563, containing the key levels at 2485, 2508 and 2563, plus the bright red middle time, currently at 2564, of the mid-December to late July this year shallowly rising bullish shift pitchfork. Next, we have a more recent shallow bullish shift pitchfork with a late July to early September move that I drew 6 weeks ago, and I said at the time, and I quote, "This last one I'm happy to finesse or even retire as the market demands," end of quote. Well, the market originally demanded I finesse this to a more acute bullish Andrews pitchfork, but after a while that stopped working, and so I've reverted back to the bullish shift pitchfork despite being breached on the top side in early October. It's highlighted in dark blue on my daily chart. The final pattern to consider is the newest one, drawn 2 weeks ago, a bright green October-based bull channel, currently 2614 to 2757. It sits right now roughly in between the dark blue middle tine on the downside, currently at 2622, and a dark blue upper tine above, that's currently at 2755. That's the channel lines. So after all this recent back and forth activity, it seems the recent effort of the market has been a try higher, utilizing the bright red and dark blue middle tines, as well as the new bright green lower bull channel line as a sort of base of sorts. Whilst overhead we have congestion primarily from the big old 50% Fibonacci line of 2008 to 2022 move at 2675, but assisted by the August 2011 high at 2666 and the 2023 high at 2671. That was until last Friday, and then again today, when prices on Friday made a fourth countering daily Q reversal down, and whilst not really following through lower this week so far by its actions of just moving sideways, well, that has seen prices test the dark blue middle tine and the bright green lower bull channel line. Indeed, the one that seems so far to have come out of this best has been the shallow bright red middle tine. This ties in nicely what I said 2 weeks ago and repeated last week when I said about the overhead congestion. I quote, "It'll be interesting to see if this cap is as strong now as it was back in early October." End of quote. Now, so far it has been, but has been sorely tested. Please note the green lower bull channel line and the dark blue middle tine crossed the overhead congestion area during the week of the 18th of November. A time and a place to watch. LME 3-month lead. There are a number of significant features on this daily chart. The first I'd like to mention is the overhead wide band of congestion originating from April between roughly 2135 to 2186. A congestion area that showed itself at the peak 10 weeks ago and again over the start of October. Next, I'd like to detail some of the supports below. Some of them well below. Okay, Fibonacci-based congestion otherwise between 1994 to 2002, followed by the June 23 low at 1976, which looked, how shall I put this, less interesting than the 2024 low in August at 1917, which I suspect is a function of the nearby 2021 low at 1908. There's also a neckline extension currently at 1939 of the July 23 to February 24 head and shoulders continuation pattern. The reason I mention these supports below is that they contributed in eroding the decline we saw in early to mid-September, enough that it was stopped and turned back upwards and brought about eventually a new pattern, a bright red early August to early September bullish shift pitchfork. The market since the middle of October had been tramping around the middle tine, currently at 2090. But late 2 weeks ago, prices broke down, specifically down through the green highlighted flatlining short medium moving average, currently 2063, and the congestion at 2058. Indeed, the action over most of October could now be seen as hesitation. I added this comment last week on this matter, and I quote, "The question now is whether this hesitation is part of a bear flag type action or a new base for a possible attempt higher. It just seems that both topside and below we have some considerable resistances and supports, which I detailed earlier. I suppose that is why the market is seemingly marking time right now." End of quote. Well, last week it seemed the hesitation had become a bearish half hesitation, a potential move down to target X in the 1980 zone. I said about this last week that it was, and I quote, "This would be a direct test of the integrity of the bright red bullish shift pitchfork, as the lower tine is right in the way below, and that's currently at 1994. But that is not all, as we do get down there and continue, then please be on the watch out for 2 bearish and 1 bullish possibilities. The action from August today could be seen as a possible large bearish cat's ears pattern, or even a larger early July to date bearish halfway hesitation. Alternatively, could be seen as an opportunity for a mid-July to date triple bottom. This is all getting very interesting now. End of quote. In all this, I truthfully did not think the bright red lower time would be that much of an obstacle on the downside, but you can clearly see that it was, as prices last Thursday staged a combined immediate countering key reversal up and bullish engulfing pattern, plus a bullish closing white mirror bozo. This move pushed up prices and avoided for now a test lower. However, the move up stalled on Friday, and at the very same green flatlining short medium moving average, and we didn't even approach the next resistance of note, which is the slowly declining medium moving average, currently at 2088. Thus, whilst this move up was a welcome indictment of the bright red lower time, I'm concerned that it may be only a temporary measure, that we may see it being tested on the downside once again, unless the topside moving averages are taken out soon. Watch this space.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Tofpik and ADM Investor Service International Limited. And here comes the final important bit.